Hey, good afternoon. Ralph Mendes, and we're going to talk about Chapter 12, creating statement of cash flows. And essentially, you're converting the income statement and the balance sheet into cash. And those are prepared under accrual basis. So, so here you are. Here's Yahoo Finance, and here's the income statement. And this is accrual because there's estimates in there. And there's estimates on the balance sheet because accumulated depreciation is an estimate, warranty, uh, allowance for bad debt. So these are estimates. So you're trying to take accrual basis, income statement, balance sheet, and prepare just the cash. You're not interested in the income or anything. You want to know where the money came from, where the cash came from, and where it went. And there's two ways to present a cash flow statement: the direct method, the indirect method. So the thing is, primarily, most everybody uses the indirect method, but the direct method is the gap. But you just don't see it. Like right here is the cash flow. So most everybody uses the indirect method, and it starts off with uh, net income. Let's see. All right. So, and then you have three sections: operating, investing, financing. All right, so let's begin. First thing in here, compute the cash flow from operations. So that's only the first section. There's operations, investing, and financing activities. So the first thing we start off with is net income. And then you're going to put in the net income of each of these companies. Now, they want you to, so this is only one section. So you add back depreciation because it's a non-cash expense, just like amortization of intangibles and would be added back. And depletion, those are estimates. So they're non-cash expenses. Then you have accounts receivable. What about the change in receivables? What about the change? Well, we'll put accounts payable. What about the change in your inventories? So you have to put the change here. And then that'll tell you anything we're missing. Yeah, accrued liabilities. And then that'll give us our cash from operations. Now, let me look one more time at Walmart. Why can't I get it start off with net income here? Cash flow from continuing. Yeah, there you go. They always start off with net income. See it? 13 billion, 13 billion, 15. So the operating section right here, gain on loss, depreciation is added back. So you're converting the income statement by starting off net income plus gains or losses minus plus losses minus gains plus depreciation. And then you do convert the balance sheet. So we're back here. So we add depreciation. Why do we add depreciation? Because it is a non-cash expense. Now, let's talk about the accounts receivable increase. If it went down, it's in parentheses. So increase, decrease. So what they're saying is accounts receivable went up those 2 years and down. Now, if assets go up, cash went down. Now, it's hard to relate that to receivables, but let's take inventory. Here, inventory went down, up. So think about it. You convert inventory. So if inventory went down, hopefully you sold it for cash. Now here, inventory went up. So what happened to your money if inventory went up? Cash went down because you used it to buy inventory. So generally, if assets go up, cash goes down. If inventory goes down, cash goes up. And it's kind of the opposite for liabilities. Think about it. If you owe somebody $100 right now and you don't pay them, your cash doesn't go down. But the second your liabilities go down, your cash goes down because you used it to pay. So let's think about this again. Receivables went up, so that means our cash went down. Receivables went up, so that means our cash went down. Receivables went down, that means people owe us less money, So that means our cash goes up. Accounts payable. Cash goes up. Cash payables goes down, our cash goes down. Payable goes up, cash goes up because we're not paying people. But if our payables go down, that means we used our money to pay people. Inventory. Inventory went down, so cash went up. Inventory went down, so cash went up. We sold it and converted to cash. Here, inventory is going up, so cash is going down. Accrued liabilities, what you owe people. Accrued liabilities increase. So this is a decrease, so that means our cash went down, we paid down. Here, we owe people money, accrued liabilities. Maybe you owe on income taxes or insurance. So if it went up, your cash went up because you didn't use your cash to pay. All right, let's see how we did. Receivables went up, so my cash went down. So what's the matter with that? Receivables went up, so my cash went down. Try it one more time. There's nothing wrong. Oh, I think I put two minus signs in front. You know what I mean? All right, so very good. Indirect, computing cash from operations. Again, just like there, you did operations, but now you get to see that you have to convert both this income statement and the balance sheet. So do the income statement first. So the steps are net income, add back depreciation, minus gains plus losses. So in our case, net income, add back depreciation, which is a non-cash expense, 54,000. Do we have any gains? We would subtract gains and add the losses. Okay, we don't have any, so we're done converting the income statement towards cash. Now, though, you have to convert the balance sheet, and it's the changes now. So from last year, 18 to 19. So we need the change. Okay, so now we have to analyze. Now, I usually like to start at the bottom and work up that way because you're working towards cash. So let's go here. Last year, you owed income taxes of 4. Now you only owe $29.50. So they went down by $1,050. Because that means cash went down because you used your cash to pay the IRS. Let's go on to payables. You owed $34.7 now, and now you owe $48.4. So your liabilities went up. So that means, let's see, 48.4 minus 34.7. So 13,700. The increase in payables is plus because you're not using your money to pay people. Where are you? Accounts payable increase. It went up, so cash goes up. So now look where you're at. There's that one, there's that one. Now we got to do inventory. Inventory went from 55.9. It went up by 13,000. Inventory went up 13,100. So what happens to your cash if inventory goes up? Your inventory is, your cash is going down. If inventory went up, cash goes down. Accounts payable went up, cash goes up. Taxes go down, you owe, your cash goes down. All right, so we got one more, receivables. What happened to receivables? Receivables went from 50 to 64. So 34, I'm sorry. So they went down. So accounts receivable went down by 16,000. So that means people paid us. So your cash from operations provided, because it's a positive. So income plus minus plus minus plus, okay, is 79,000. Our cash went up from operations by 79,000. So that's where the cash came from. Net income plus add back depreciation, right? All right. Now, you should be able to do this one because we've already done two of them from the cash flow. But now, essentially, you have to start off again. Net income plus depreciation. Net income not affecting cash, that's depreciation. Then you start, there's no gains, no losses to add or subtract. So then you start on the balance sheet. Now, here's the thing though, the operating activities. The operating activities are income tax payable, wage payable, accounts payable, and does not include furniture in that in the current assets. So it's the change in these current assets and the change in these current liabilities. Okay. All right. So let's just say, let's list them. So it would be, what's the change in income tax? Oh, we got to put increase or decrease. So got to go. So income taxes payable went down by $800. So that's a decrease. So cash went down by $800. Now over here, what else? Accounts wages payable went up. 56, 66, 76. $3,600. Accounts payable increase, wage payable increase. So cash is going up. How about accounts payable? 19.6, they went down. It went down 5,700. So that means cash goes down 5,700. So accounts payable decrease, accounts payable decrease. So when accounts payable goes down, your cash goes down. Wages pay, liability goes up, your cash goes up. All right, so now you have to finish the prepaid expenses, inventory, and accounts receivable. All right. Computing cash from an asset sale. All right, so let's do this. Furniture had a beginning balance of 144. Oh, I'm sorry, prior year, 200, 500. And at the end of the year, see, we've got to, it's doing it automatically, the end, so we've got to get it to match that 144. Now, accumulated depreciation is 114,700. Remember, it's a credit, and that's why it's down here at a credit. And we've got to get it to 92.7. The current year income reports depreciation expense on furniture of 22. So remember from your midterm, depreciation expense, what's our numbers here? Depreciation expense of 22. So remember from your midterm, depreciation is 22. Well, accumulated depreciation goes up by 22. Remember that? A debit and a credit. So here, if depreciation expense, we don't have that, but then we know that accumulated depreciation is credited by 22. So here we go, 22. There we go. Now, what else do we have? During the year, furniture costing $56,500 was sold for its book value. So that means, let's go back to what the midterm looked like. If we had, we don't have equipment on here. Let's just assume it was a $56,500 computer. And if you get rid of it, you have to credit equipment. See, to get rid of it, to get it off your books, you have to credit it. So in this problem, we have to put it on the credit side, right? $56,500 is gotten rid of. All right. So guess what? Look, beginning balance minus this equipment we got rid of, and we match this 144. But we do not match this 136. Now, in this case, depreciation expense was sold for its book value. So to me, it seems like if the equipment was $56,500, we don't know the book value, but 136.7 minus 92.7 is 44. So that'll get us to the 92. And this is right here. We put here, let me just see if this This is a sale of the asset. I'm sorry. Yeah, and this one here is just depreciation. And this one here is sale of that asset. So this sale gets it off, sale, and then they made a gain. I'm sorry. Let's see. It's furniture. Yeah, you credit it and you debit deal, and then it was sold for the book value. So, all right. So there, let's see how we did. Oh, so the cost. So let's see, what does it want now? So the cost was 56.5. The accumulated depreciation was 44. So that means the book value was 12, and that's the cash you see. Let's see if we got it right. There we go. And how do we figure those out? Just go with what you know at first. Beginning balance. Get rid of an asset. And remember, if the cost was 56.5, and the accumulated depreciation is 44, then the credit doesn't match the debit, right? So then it has to match 12.5, right? This plus this then has to match 44, 54, 56.5. You see how they match? Debit, debit, now match that one credit. Okay? All right. So always use T accounts when you get stuck. All right. Computing investing. Now that is your, remember over here we had operations. What was it? I asked you to remember. Oh, I forgot. Operating, investing, financing. So now they're asking you to look at investing. Investing is investing in yourself by buying machinery, property, plant, equipment, or investing in other companies, like buying the stock of another company. All right, so cash received from a sale of equipment. Equipment with a book value of 52 and original cost was sold at a loss. With a book value of 52 was sold at a loss. So the thing is, if 52,000 is the book value, and it's lost minus 5,400. So anything above 52,000 made a gain, anything below. So if I take 52 minus 54, means they got 46.6. Okay. And what was the depreciation? How much depreciation expense was recorded on the equipment? Well, it looks like it was 234. It was sold at a loss of 54. Computing and investing. How much depreciation expense was recorded on equipment? All right, so the book value is, remember, the book value is 270 minus the accumulation. We don't know, but that'd be equal to 52. So if I take 52,000, then I know the accumulated depreciation was 218. So then, 234 minus 218 equals 16 afterwards, but it's all the way up to 124. So I'm going to say it's 108 was the depreciating expense. And so number one, how much cash from the sale? Depreciating expense 108. What was the cost of new equipment purchased by? And let's see, and equipment went from 330 to 240. So let's look at the T account again. 330, and at the end it's 240. Now, what do you know if you says here original cost of 270 was sold? So that means this account went down by 270, right? Because you had this much at the beginning. You got rid of a piece of equipment that cost that much. Right here, it tells you it was sold. 270 was sold. So now, look at it again. If you had 330 minus 270, well, what number do you need right here to end up with 240 at the end of the year? So 330 minus 270 equals what? 60? Is that 60? Yeah, 60. So how much did you buy to go from 60 to 240? So it's 180, would it be? Would it be 180? So like I say, that's why I recommend you use T accounts. Like I don't know the answer right away. Take a look. 330 at the beginning, 240 at the end. We got rid of equipment. So what number do we need to end up with 240? Because after minus 330 minus 70, only left 60 there. So 60 plus the 180 will give us our 240. All right, so please use T accounts. So let's check our work. All right, very good. And that's not easy. That is not easy at all, what they're asking you to do there. You're really going to have to think about this section. Number 5, you're really going to have to think about it. All right. So same thing here. You're going to have to think about it. Take your time. And again, use T accounts. All right. So in this case, I just delete them. And then you work again. All right. You put in that data. Cash received from the building, things like that. All right. Computing cash from investing, sale of short term. Compute the cash flow from investing using the above information. Amounts to be deducted should be indicated by a minus. Sale of short term stock investments. So cash came in from sale of stock of $3,700. Then cash collected from customers. No, that's operating section. Purchase of used equipment, and that's money going out. So there you go. Depreciation is part of operation. It's not investing. And there's your cash used by investing. Where's used? See, because cash went out. So it's not provided by, it's used. All right, now financing is the last section. Remember, operating, investing, but now you have financing. And what comes from financing is if you issue stock and if you pay dividends. Look, see, they pay $6 billion a year in dividends, Walmart, very consistently. But then here, it could be if it sells stock or buys back its own treasury stock. So let's try this one out. Common stock started off with 124, and the paid-in capital started off 354. They don't give us the, oh, they do give us the retained earnings, 311.5. Beginning balance of common stock and beginning balance of paid-in capital. These are all credit balances. All right, so now let's see what happens. The income for the current year, it was $60,000. Complete the T accounts to calculate the cash received from the sale of its common stock. All right. So first off, if the company's net income, what happens when you have income? Retained earnings go up, right? Current year net income goes up by 60,000. All right. Now, the following information, Princeton's company. So how much stock did it sell? So, okay. So let me think a minute. To calculate the cash received from the sale of common stock. So here, the ending balance is 133. So what number So this would have to be a $9,000 credit, and that would be there. But then this ends up at $591. So this had to go up by 237. So think about the journal entry. So this is a sale of stock, and this is a sale of stock. So the cash, remember, let's go back to our journal entry. Cash So cash came in, common stock paid in capital in excess of par. Remember that from common stock. So what are our numbers? 9 and 237. 9, 237. And the cash would be how much then? Well, it's the sum of this. It'd be 246, right? 246. So if we go back here, so the cash received is 246. Let's see, where do you put this? Okay, so I'm a little confused on this one, but let's check out how we did. T account, oh, cash paid for dividends. Yeah, okay, I wasn't thinking. I had to finish this section. So, all right, so we got the first two parts right. We've got to finish this. First off, retained earnings goes up on that side, and dividends make it go down on this side. So 311 plus 36 is 317, but the retained earnings end up at 337. So let's look at it again. 311.5 plus 60,000 is 371. So how can it go down from 371 minus 337,500? Because you must have paid dividends of 33.5. All right, so now let's try. So it's 338. So I subtracted again. So I'm at 338 and I'm supposed to be at 337.5. So this should be what, 34,000, another $500. I don't know how I missed that, but let's find out. All right, fair enough. So again, put in what you know. Beginning balance 124, beginning balance 354, beginning balance 311. Of course, net income makes retained earnings goes up. But then to find your any number, it doesn't tell you the dividends, but they make it go down with a debit. Over here, if the common stock went up by that much and paid in capital went up by this much combined, that's the cash. Because remember from the journal entry, common stock plus paid in capital equals the cash you received. Okay. All right. Let's try another one. Computing cash from financing. Short-term borrowing, purchase of short-term stock. No, that goes in investing. Cash dividends paid, yes. So additional short-term borrowing. So additional short-term borrowing, money goes, your cash goes up when you borrow money. But when you pay dividends, it's going down. So cash provided by financing is 3,600. So cash goes up because you borrowed money. You pay dividends, it goes down. Now, so where do investments go? Investments go in investing section. They don't go into financing. And the interest paid on your debt goes up in operations. All right. Now, again, here's an operating activity. So you've done several of those. Look, though, here's one. So you start off with net income, and you add back depreciation, but you have to subtract the gain, because when you sell equipment, that's part of your investing. So you get rid of that gain by subtracting in the operating activity, and then you add it in what actually came in. So let's get you started here. Net income. Okay. And we add back depreciation. Where are you? They have amortization of patents. Yeah, let's put that in there. Good. What else do we got? Depreciation. Good. And what else do we have? Gain on sale. So let's talk about this. Amortization expense, again, is an estimate. It's not a real number, so we add that back. Depreciation is an estimate, so we add it back. Gain on sale, it was added to this, so really the income, so by subtracting it, we get it back to the 734, 9544, 9544. All right, so now we have it. Now, remember now, that's the income statement. So that's what it wanted you to deal with. And here it just gives you here the accounts receivable. Accounts receivable went up. Increase in accounts receivable. Inventory went up. Increase in inventory. Accounts payable had a decrease. And salaries payable had a decrease. All right, now let's think about it. Where's decrease in salaries payable? So salaries payable went down, accounts payable went down, inventory went up, and receivables went up. All right, so now if receivables went up, what happened to your cash? Down, because people didn't pay you. If your inventory went up, what happened to your cash? Goes down. If decrease in accounts payable, you had a decrease in accounts payable, so your cash went down, and your salaries payable went down. So there you go. So your cash flow provided by operating. So let's see how we did. All right, net income plus the two non-cash expenses. Get rid of the gain and put the actual money that came from selling and investing, and then your changes in your accounts. All right. Okay. Now, let's see. Here you're putting it all together. What do we got here? And there you're putting it all together. Oh, what is this? Compute the company's cash flow on total assets. Okay. And here's the direct method. So now, how did I get this cash amount from customers? So if you sold everything on cash, it'd be 560,000, right? So it's beginning receivables plus that sales minus the ending. So your receivables are bigger at the end, so that means you have that difference tied up. So that difference is what's subtracted from the sales. All right, so let's see if I can show you that here. Operating the cash receipts. Cash from customers. So your receivables were this, plus your sales, minus your cash receipts equals the ending. So you can see your receipts were less than your sales because the balance went up. So because the balance went up, your cash receipts are different. So you have to take into account the difference in receivables. So in our receivables, they ended up. So 64 minus 47, and you subtract that from 560 to get how much cash came in. Now, cash paid for the rent. The beginning balance of what you owe on the rent, plus your rent expense, minus your ending balance, will give you what you actually paid for the rent. And in this case, it's less what you owe at the end. So that couple $1,000 is added to it because your rent payable went down. Now, cash paid for inventory is a little harder. So let's see. Let's see if I have it here. Do I have it? All right, so we'll go here. Cash paid for the inventory. Beginning inventory plus what you bought minus your cost of goods is equal to your ending inventory. What was your inventory? 70,000. We bought 300,000 more. We sold this much. There's your ending inventory. But to get how much cash went out, the payables, you have to take the 314 purchases, and then what happened to the payables? Well, the payables went down. So if payables went down, that means by that 5,000, the purchases are 314 plus an additional 5 because payables went down. Now, if payables would have gone up, you would have paid less. But in this case, your payables went down. So you got to figure out your inventory plus your payables there. Got to figure out your change in inventory. Okay, I'll show you one more time. Got to figure out your change in inventory. Beginning plus purchases minus what you sold equals your ending. And then here, what you owe plus your purchases, same number, right? 314 minus what you paid is equal to your ending payable. But then you got to look at the ending, 40,000, and it went down. So you got to add that to your purchases, 314 plus the 5. All right. Oops, lost it. All right, so we'll do one more thing here, looking at this indirect method here. A 30,000 note payable. All right, so here you're putting the 3 of them together. You're putting the 3 together. So let's see if we can get you started. We're going to start off with net income. Do we have net income? Yeah, 101,510. What do we have non-cash? We have non-cash is depreciation. What else do we have? Gain on sale. So we have to subtract the gain. Gain on sale. So minus 2,100. What's our depreciation? 59.6. Then under operating section. Now they give us some additional notes here. A 30-pound is retired at 30,000. So in exchange for cash. A 30,000 note payable is retired at its 30,000 carrying book value in exchange for cash. So that's financing. So that means, where do I have long-term debt? Do I have it? Cash paid. We'll put dividends there. How about the next section? Cash paid to retire note. There it is. And the cash paid to retire note minus 30,000. So money's going out. Okay. All right. So now let's finish the income statement. Net income minus the gain plus depreciation. And that's the 2. There you finish the income statement. So your next thing you have to do is convert the balance sheet. Now, let's see what else. Anything else I notes? Only change effective retainer, net income, and cash dividends paid. So right away we can tell new equipment is acquired for 58.6 cash. So right here, minus 58.6 cash going out for new equipment. So there you go. That's one of the notes. Cash received for the sale of equipment that it cost 49 yielded 2,100 gain. So that's new received cash for the sale of equipment that it cost 49.6 yielding a gain. Depreciation. So we're going to have to see there's some more work in there. And all right, anything else in the notes? All purchase of sale of inventory on credit. Okay, so first, let's attack the retained earnings. What was the beginning retained earnings? 24.4. 24.4. Okay. Now, 24.4. And how much did it go up by? Net income, 101,510. 101,510. Now, in this case, we're told that the ending retained earnings is 51.6. So what were the dividends? If you start off with 24.4 and you have this amount of income, how could you get to that? So in your calculators, 24.4 plus 101,510 is 125 minus 51.6. So that had to be that you paid dividends of 74,310. And remember, dividends make it go down. Remember, dividends when you close out? 74,310. So I say, I think it's 74,310. Dividends down here. Dividends. All right. So think about it again. Beginning retained earnings 24.4, 24.4 plus our net income minus that will give us that. And that's how. So now we finished retained earnings. Common stock went up. So that means they sold stock. There's no APIC. So common stock went up by 61,000. 161 plus another 61 is 222. So we sold stock of $61,000. $61,000 right here. Oops, wrong place. Goes in financing. Sale of stock. Cash from sale of stock. There you go. So this is probably, so this is cash used in investing. All right. Let's keep going. Note payable, 61 and 31. We already took care of that. That's the 30,000 going down here. You see how we're working our way up? We did the income. We already figured out retained earnings. Now we did the stock. Now we know payable. Now, how about income tax payable went down by 500. Decrease in income tax payable minus $500 cash. Wages payable, 15.2 minus 6,100, $9,100. Decrease in wages payable minus $9,100. Cash goes down. You see how you're working our way up. The accounts payable, 31.5 minus 26,000. They went down. Decrease in accounts payable. Decrease in accounts payable. Where are you? Minus 5,500. So cash goes down because all your liabilities went down. Every liability went down. 31 to 26, 15 to 6, 4 to 3. 50,000, you're only at 35. It's all cash being used there. All right. So now prepaid expenses went down. So that means cash went down as well. And they went down by 56, 46, $1,100. So decrease in prepaids. Let's see. Prepaids 56. Now they're down. So I'm sorry. It's cash goes up because you didn't spend your money on it, that asset. All right. Inventory went from 88,000 minus 64.8. So assets went down. So this is a decrease in inventory. So cash goes up. Okay. All right. And let's see what else we have. Receivables, 52 to 66. So receivables went up by 14,500. So the increase in receivables makes our cash go down. Increase in accounts receivable. There you go. Now let's see. We're missing one thing. We took care of note A, the $30,000 note. We took care of the dividends. We took care of the equipment. So right here is the last one we lack. Equipment for the sale of equipment costs $49,600. So $49,600, but accumulated. So we got to analyze our accumulated depreciation of equipment. So let's go here. Accumulated depreciation started off at 9,500. Then our depreciation expense for the year was 59,600. So that made it go up by 59.6. Then at the end of the year, accumulated depreciation is 27.5. 27.5. So what do we need over here to end up? So this plus this minus this will equal that. So let's see, 9,500 plus the 59.6 depreciation expense is 69 minus 27.5 means that piece of equipment we got rid of was 41.6. So let's see, the cash, and then we had accumulated depreciation. So here's my debit. Here's my credit. Again, T accounts. So we don't know this. We know this is 41.6. And then we also know to get rid of equipment, what do you have to do? You have to it's a debit. So look here to note, it costs 49.6. So over here, when you have 49.6 equipment, to get rid of it, you credit it. So equipment is 49.6. Okay. And you have a gain. They tell us what the gain is, and a gain's a credit. Right here it tells us the gain was 2,100. So the journal entry is 2,100. So 49, 50, 51. So 51,700 credits. So they have to add up to this. So 51.7 minus 41.6. So that means the cash you got was 10,100. So if you would have got this much cash, accumulated depreciation, you're getting rid of the equipment, you get rid of the equipment, and your gain, and then they'll add up, right? So this is equal to this plus this. So 51.7, now the debits and credits match. So on our problem, the cash came in from the sale of the equipment. Cash right here, cash from sale of equipment. Sale of equipment, where's it at? Sale of equipment is 10,100. Is that what we said? 10,100. So now, so this is cash. So now 43.6 used. Here is this cash used by in investing. This is cash provided by operating. So now you add the three together. 153.710 minus 48.5 minus 43.310 is 61.9 is your change. Your cash at the beginning was 45,000. Put that number there. And if you add the two together, so let's go up and see if the ending cash is 106.9, and it is, and that means we got it right. Boy, that's a hard problem to get y'all starting off, huh? That's a really hard problem. All right, so hopefully this helped you, and y'all have a wonderful day. And this is your last chapter, cash flow. Very important chapter in life, though. Everybody needs